Hey, good morning, everybody. Thank you for joining us this morning. I know everybody's got a lot going on, and there's clearly a lot going on in the world, but we wanted to do this morning, and thank you, Southwestern, for having me in to talk with everybody. It's just give you a sense of what is going on in the world and where do we think it's going to go from here. If you've not seen us before, BlackRock, I've been with BlackRock for 16 or 17 years at this point. I am blessed to work for the largest investment company in the world, and we do investing all around the world. And so we do have a perspective that I think most firms don't have. And so I'd love to talk a little bit about the year we've had so far, and then we'll talk a little bit about where we think it's going to go from here. And there are four main stories in the world at the moment: the election, the virus, the trade war with China, and the response that governments around the world have put into place to try to heal the world. And so we want to hit on all of those things and make sure you at least have a sense of what's going on with your portfolio and with your investments as we go into the last quarter of 2020. And look, it's been a crazy year. If you started in January 1st and looked at the research from BlackRock or Raymond James or any of these firms, you would have found that we were pretty excited, right? We were pretty bullish in financial speak, right? You had ultra low interest rates. If you're trying to buy a house or start a business or borrow money for any reason, companies were super healthy, earnings were really good. All of the traditional signpost, taxes were really low. All the traditional things that we pay attention to looked really good. And then out of nowhere in February comes this virus from China, and the world just stops. And that to us is unique. And the only other time in the last 100 years you could really point to was really the Spanish flu of 1918. Every other recession that you've lived through is fundamentally different than this thing, because this thing involved billions of people, number one, afraid, and number two, locking themselves in their houses for an extended period of time, right, and not spending money. And so that's what we did. We didn't spend any money. And so you saw this massive downturn in the first quarter, a really big pullback in the market, 30+%. And then the markets come raging all the way back, largely because of the government stimulus that we're going to talk about here in just a few minutes. And now where we're at is the market's actually up. And it's crazy that this has all been 1 year. It feels like yesterday that we were all still really scared in our houses in February and March. And obviously lots of people have lost their lives. Millions of people have been impacted. But through this entire roller coaster, somehow now your stocks are up on the year, your bonds are up on the year, cash still pays nothing. But by and large, if you just fell asleep January 1st and you woke up today, you'd look at your portfolio and go, it's been okay. And if you didn't know what had happened, you wouldn't know otherwise from a total return standpoint. Now, the stocks have been really interesting because the world has rewarded companies that don't need you to leave your house to be successful. The world has rewarded technology companies. Netflix doesn't need you to leave the house to be successful. Apple, right? They've rewarded healthcare companies. We spend money on healthcare regardless of, and maybe more now, regardless of what's going on in the world. And it's punished companies that are really economically sensitive. Small companies, little companies are really sensitive to the economy. The old brick and mortar companies that pay good dividends that you know and have owned forever have struggled too, because so many of those companies really need you to leave your house, get out into the world and go spend money. And so we've seen this huge difference between things like technology companies have done incredibly well this year, and then old school dividend paying high quality stocks are still down 10 to 15% in many cases. Some would argue there's a lot of value to be found there, but a huge difference. So if you just look at the average, it's up a little, but there's a big difference between what we'll call stay-at-home stocks and what we'll call get out of your house and go back to living stocks. And the question really becomes, where do we go from here? And I've got some slides that I want to show you, but before I do that, I would just caution you to say media is in the eyeball business, right? And there are three huge negative stories in the world, and there's one really positive story in the world, but media is in the eyeball business. So whether it's on social media or the television or the newspaper, they need you looking at them. And so you are only generally going to hear about the negative things. And what I'd love to leave you with today is just a little bit of positivity to offset all of the negativity that's flowing at us at all times right now. And just remember, that media companies would kill for any one of these stories, really. They would love for just the virus. They would love for just the trade war. They would love for just this crazy election, and they're getting three of them at the same time, right? So that's why we would generally recommend get your investment news from your advisor at Southwestern. Don't get it from CNBC because they do not have your long-term financial plan in their best interest, your best interest at heart, right? And so, again, we're going to talk about these four main stories because this really is what's going to dictate the next 3-6 months. And everybody's fixating on the election, and we get it, but there's more out there than just the election. So we're going to talk about four different topics. Let's start with the first one, which is this virus. And look, still people dying, still people getting sick. America, if you look over here on the right, seems to be spiking cases. Europe has had really low case counts, but that seems to be rising a little bit as well. And we would say that's for a couple of reasons. Number one, there are more of us, right? There's hundreds of millions of Americans. Number two, we are testing more than most places. And number three, Americans largely feel like we've had enough and we're going back to life. I live in Middle Tennessee like so many of you all do. And you can kind of feel it. People are at the grocery store, they're going to restaurants, kids are playing sports, many kids are back in schools, people are going on fall break, right? People just feel like they've had enough of COVID. And so we are out, we're spending money, we're many cases back in the office. And so it feels to us, all of the data points to the idea that even if the cases get worse, you're going to hear lots about a fall spike, right? I've already read an article that was mixing the cold season with COVID with flu season and some super terror thing, right? That's just media in a nutshell. Even if that were to happen, though, even if we were to quote unquote shut back down again, which we don't think is going to happen, we do believe the worst of the economic news is behind us. What you see over there on the left, it's a little creepy, but Google tracks people's mobility, how much they're getting up and around. And even though we have more COVID, we are just as mobile as all of the other developed nations in the world. And so we do see the economic news is getting better. We do see earnings are getting better for companies. All of the traditional signposts are ever so slowly moving the right direction. Now, I won't sugarcoat it. We are not in the camp that believes we're going to go right back to normal. We think there are going to be very long-term lasting impacts because of what's happened so far this year. And we're going to talk some more about that as we go through. But we do believe the good news is that the economic news, the worst is behind us. And yes, we understand there are millions of families still out of work and impacted by this. But as a whole, we do believe the economic impact is slowly moving the right direction and that the worst is behind us. So again, you're going to get the death counts and the case counts and some of the sad stories. We just want to offset that with at least a little bit of good news from an overall economic standpoint. The second source of volatility, and make no mistake, the virus is an absolute source of volatility. Feels like there's a vaccine, market goes up. Feels like there's not going to be a vaccine, market goes down. Shut down, market goes down. Things are opening up, markets go back up. That first one, absolutely going to be a source of volatility in the near term, in our opinion. So is the second one. And people have largely kind of let this one off the front page of the paper because there are more interesting things to talk about. But we would just remind you that this story, this U.S.-China story, is not going anywhere anytime soon. We believe it's going to be with us for the rest of our lives. And the reason for that is if you see here in yellow, China is now a larger economy than the U.S., Europe, and Japan combined. They're a massive economy. And we have fundamentally different beliefs. And so the idea that we're all of a sudden, regardless of who's in the White House, just going to start getting along with them and agreeing on social policies and on intellectual property and technology theft, we just don't think that story's going away. And so you add on to that a second source of likely volatility. This one, again, is going to be with us for a while, but it does feel like this is ramping up a little bit. In the near term, it feels like both parties, Democrats and Republicans, are talking a bigger game about getting a little bit tougher on China. So put that one onto the pile. And then there's the third one. And look, this is the messy one. I will do my best to avoid taking a side in this situation. But what we're finding is, and what all of your advisors are finding at Southwestern, is there's fear everywhere around the election on both sides, right? And so Republican clients are terrified of what you see on the screen, scenarios number 1 and number 2. They're particularly concerned with scenario number 1. Democratic clients are worried about scenario number 3. They cannot fathom another 4 years of the Trump administration. So on both sides, people are scared, right? And what we're finding is that's leading to people reducing way too much risk in their portfolios. We as a country right now are totally locked in on this election. It's the only thing we're worried about. It's the only thing we're talking about. But just remember, the market, generically speaking, has a lot more inputs than just the election. And history tells you if you are one of the folks that's considering going ultra conservative with your investments and waiting out the storm, you are going to end up missing significant returns in your portfolio. Everybody wants to tell us this time is different, and we would agree the heat is higher, the stakes feel a little bit higher. There is the chance for a contested election, which could lead to some longer term volatility in the portfolio. But history says it will not be different. History says you will see volatility leading up to it, that you will see volatility right afterwards. And why is that, right? Because whoever feels like they lose wants to sell, right? I mean, anybody, the Republicans, if the Democrats sweep, are going to want to sell. Democrats, if Trump stays in office, are going to want to sell. And again, history says that will be a mistake. I would remind you, 3.5 years ago, when Trump won, the world was supposed to end, right? And the market sold off 1,000 points overnight, and bond prices spiked because people were afraid and people ran to bonds. And then a month later, we all looked around and said, well, that was dumb. And 3 years later, we had one of the longest, strongest bull markets in the history of the United States, only really stopped because of COVID in the last 4 years. And so just be very careful letting your political beliefs drive your investment behavior, because there is absolutely no history that supports the idea that one party is better than another party. I have another slide that I don't have my hands on at the moment that shows there is no difference between single party government and divided government. There is this widely held belief that divided government is better for the market. And we would agree that divided government means less overhauls, but there is no data that supports the idea that single party government, regardless of the side, is better or worse than the market. It's actually right about on average. The other thing we would say is that you would expect presidential election years to be worse on average than the normal year. In fact, they're better. And look, again, this year might be a little more heated, but the truth is that they're always yelling at each other. They're always fundamentally disagreeing on the direction of America and policy and all these things. And yet, presidential election years on average are better than other years, which I find kind of fascinating, right? Because they're always contentious at some level. And the reason goes back to what I talked about a few minutes ago, which is there are just too many inputs, right? There's too many parts on this car, right? If the door gets broken, the car's not broken at the end of the day. And America's economy is too complex for that. Will there be winners and losers? Absolutely. We put out a paper this week that said you would expect the energy sector will struggle if the Democrats sweep, that tech may get some new regulation if the Democrats sweep, right? And that if the Republicans sweep, you'll largely see business not change all that much and the rules not change all that much. If tax rates go up, municipals will have a pretty good run. If we had to guess, people will care much more about the tax they're paying. We adapt, is my point. Americans adapt, businesses adapt, the American machine rolls on. And that's not to say it won't be a volatile couple of months, because we believe it will be. It just means if you run and hide in cash, history says you will be making a mistake. But that's exactly what we're seeing right now, right? Right now, if you look through yesterday, there's about $6 trillion sitting in cash, about double what we started the year with. Now, bear in mind that at previous moments of what I'll call peak fear, January of 09, January of 03, right? Tech bubble, housing bubble, right? At other moments of peak fear, at least you got some yield. Today, you get no yield, right? Cash pays zero, and the Fed has said it's going to keep paying zero for at least 3 years, but probably 5 years. So if you're one of these folks that's got a bunch of money sitting in the bank and you're waiting for rates to go back to normal, you are incredibly likely to be waiting for a very, very, very long time. They are going to make it so painful to leave that money sitting there that you go do something else with that money. They are begging you to go do something else with that money, right? History also says, and this is just behavioral, that at moments of peak fear, people are setting themselves up for disappointment. Over here on the right, you see what happened over the following 3 years, following other moments of peak fear. And what you find is really big returns for the market. And here's why. It's because this game is hard. There was nothing about March 26th of this year that said that was the bottom and you should go buy stocks. There was nothing in March of 09. Jeff lived it with me. In March of 09 that said you should go buy stocks. But that was the beginning of one of the longest bull markets in the history of America. You are not going to know why the market all of a sudden starts to pick up and do what it does, but lots of history says that's exactly what it's going to do. And you might say, this time is different. How is that possible? You just talked to me about this election as a source of volatility. You talked to me about this trade war ramping up, and we all know this virus thing is going on. How is it possible that the market, that my investments could keep going up with all of that stuff going on in the world? And the answer, one of the big answers, is stimulus. Right? I'm just going to give you this example. And this is the little ray of sunshine I wanted to put on the back end of this conversation, which is we believe what the governments of the world are doing is largely offsetting all of the negativity in the world right now. What do we mean by that? If you look around the world, we are on pace in 2020 to do about $10 trillion of stimulus as a globe. Now, the president says he's cutting off negotiations this morning. That may or may not be true. That could be a negotiating tactic, right? We believe there's more coming, both here and around the world. But let's just say we did no more. We're on pace right now to do $10 trillion of stimulus around the planet. Now, just to give you perspective, that is about 8 times more than we did during the entire financial crisis 12 years ago. And look, if you invested through the financial crisis, you know this is not that, right? That was banks going under, mortgages going under, your house potentially going under, investment markets really, really in danger. This is an earthquake that stopped the world, and we didn't leave the house and we didn't spend any money for a little while, and then it'll slowly start to go back to normal. And yet, we are on pace to do at least 8 times more stimulus this year than we did during the entire financial crisis. And what that means is so much of it is this red thing which says securities holdings, it's bond buying. The governments of the world have been buying all of the bonds they can get their hands on. In fact, America hired BlackRock to help them do that, right? But they're buying as much fixed income, as many bonds as that they can get their hands on. And the reason they're doing that is they want bond yields as low as your savings account yield. They are trying to drive bond yields so low that, again, you go do something else with your money. So now you have cash pays nothing, bonds pay very little. 80% of the bonds on the planet now pay less than 2%. That's pretty remarkable when you think about it, right? Commercial real estate, for the time being, is a little bit of a mess, and there will probably be some opportunity there. But lots of companies around the world rethinking how much space do we need, right? Cullen's doing this from home, and they're doing it okay. How much space do we actually need? So cash is a mess. Bonds have very little yield, and commercial real estate is a mess for the time being, which is leading people back to stocks over and over and over again. And we don't think that's going to change anytime soon because the Fed has said we are going to keep rates like this for a very long time until we see meaningful inflation, 3 to 4% inflation, which we have not seen in a very long time. And so again, if you're sitting around waiting for your savings account and your bond account to pay a lot more yield, you are likely to be waiting for a long time. And look, here's the deal. People have to make money. The Tennessee Teachers Pension has to make money. Vanderbilt's endowment has to make money. Retirees have to grow their portfolio to be able to live the way that they had anticipated. So people are going to have to take risk. We think it finds their way back to stocks over and over and over again. And that's how, even with those 3 sources of volatility, which we would agree, right, are in the world, that's how you can still see your investment accounts climb, even with all that noise going on in the world right now, because frankly, there's just not another great place to put the money. People always think volatility means down. Volatility means losing money. That's actually not true. Volatility just means your account is moving around more than it normally does. It can move around more and still go up over time as well. So just keep that in mind as you think about the headlines and you read the paper and you watch TV. Just bear all of that in mind, because this amount of stimulus we have never seen before as a planet. The other couple of things I want to talk to you about are some very basic old school blocking and tackling topics, right, that I know your advisor is talking to you about, but I want to explain to you why they matter so much, right? So the first one that everybody falls asleep when we start talking about is rebalancing. Why does rebalancing matter so much? Well, it matters especially during volatile markets like the one we're in right now. If you think about 12 years ago in the financial crisis, at one point, a portfolio that started out as 60% stock got down to 38% stock because of the downturn in those stocks. So now you're at 38% stock when you're supposed to be at 60, and then the world takes off. If you didn't rebalance, you didn't have enough money in stock to participate on the way back up. That's why we preach things like rebalancing, because if you don't do it, you don't have the right amount in stocks to participate when it goes back up. Now, this year was a lot less scary, right? So it didn't feel less scary, but at one point your 60% stock portfolio got down to 51% stock. And again, if you didn't rebalance, when the market went up 45% on the way back up, you had 10% less stock than you were supposed to on the way back up. So when your advisor talks to you about things like that, and you go, why would we do that? The world's still scary. This is why we do it, because you got to be in the game to participate on the way back up. So just remember that, because you're likely to have that conversation in the not too distant future. The other side that we're starting to see this year is the rise of the do-it-yourself movement. And I think it's natural. There are millions of us working from home, a computer screen, some extra free time, staring at our accounts way too often, and people have started trading individual stocks again, right? Things like Robinhood.com and Schwab and all these online places where you can do it yourself. And there are stocks that if you bought them this year, you probably feel like a genius. If you were lucky or smart enough to buy Apple or something like that in March, you probably think this game is easy. And you probably feel like the smartest person on the planet. Now, for everybody that bought Apple, there's also a lot of people that bought airlines thinking those had to go back up, and people that bought Exxon thinking it looked cheap. This year, 60% of stocks are still down in 2020. So it's not as easy as just picking a tech stock and watching it explode. History tells you it's about a 50-50 shot. Okay, that's a coin flip. In fact, it's a little bit worse than a coin flip at this point, right? So just be careful convincing yourself you can do it yourself, because this game is, again, incredibly hard. And people tend to talk about their winners. It's kind of like gamblers. They always tell you about the games they won, not the games, all the games that they lost. Investing is kind of like that at cocktail parties as well. All right, last major point, and then I'm going to stop. And Jeff, I don't know if we have time for Q&A or if you want to take them in the chat room. But the last major point that I want to hit home.
And before you hit that slide, would you can I just mention that if anybody has questions, if they could please go to the Q&A section and type in their questions. After Cullen wraps up here, we'll get to those questions.
Excellent. And so here's the last major point, and this is the sleepiest of the sleepy topics that you are tired of talking to your advisor about, but I want to explain to you why diversification matters so much, even when it doesn't feel like it matters. Because it works against our human nature. And our human nature is to drift back and forth between fear and greed, right? We're wired to be fearful. We are the descendants of the most fearful people that knew to run from lions thousands of years ago, right? That's us. We're still around. And yet we also can be incredibly greedy in short amounts of time. It's just the nature of investing. So in years like the tech bubble or the housing bubble, right? Take the housing bubble, the market's down 37, your diversified portfolio is only down 24, But your brain says, yeah, but I'm still losing money. I don't like that, right? And then you get these big bull markets like 2009 through 2019, and the market went up 350%. And that sleepy diversified portfolio was only up 190%. Your brain says, should we be taking more risk? This market just seems to keep going up. Should we be more aggressive? And so again, we just drift back and forth from one to the other. It's incredibly natural. But the reason this matters so much is because that sleepy diversified portfolio actually ends up with more money in its account than just buying the market and forgetting about it. All right. So when you think about it, the reason that is because even after these incredible bull markets like this, right, downside matters significantly more than keeping up with the market when it goes up. So what do I mean by that? Let's say you have $1 and you lose 50 cents. In fact, I'll stop sharing, Jeff, and we'll put us back on the big screen. So if you have $1 and you lose 50 cents, now you're at 50 cents. You're down 50%. To get that 50 cents back to $1, though, you don't have to be up 50%. You have to be up 100%. So you're down 50%, but you have to be up 100 to get back to even. It's just a quirk of mathematics, but it's the reason downside protection matters so much more than keeping up with the market over longer periods of time. All right. So just remember that. That's the reason we preach a diversified portfolio. And it's the reason we beat that to death when we're talking to you guys about investing. So Jeff, I'm going to stop for a second and let you see if there's any questions, or if not, let you just wrap it up. But thank you.
Thank you, Cullen. If you have any questions, please go. We don't have any yet, but that just means, Cullen, that you did an awesome job with your presentation. I think your comments on the central bank and what the governments have done have really been impressive. I've shared this with a lot of clients right as the market was just starting to tank with COVID. We talked to several real estate developer friends, and they had already been notified by the banks that they were going to be able to have reprieve on their mortgages, and were already able to call their tenants to let them know that they were going to have 3 months to delay. And so it doesn't matter. History will tell whose administration was responsible for that, if that was back from Obama's administration, if that was back currently with Trump. But there were massive changes and lessons learned from the latter year of Bush with 07, 08, and early 09 through the Obama administration, and then with the Trump administration. And it's really remarkable. 8 times the amount of fiscal improvement and loans through the financial crisis, and how quickly that was done saved just a catastrophe from happening. And I'm grateful for that. So there is a lot of debt, as you know. Will you talk just briefly on that? And that's probably not something that's going to matter in the short term, but I know clients and folks do ask about how that's going to impact things.
Yeah, no, we get that question all the time. So here's the deal. We have a lot of debt, and we are like a family with a lot of debt. How does a family with a lot of debt get out of that situation? They have a couple of choices. Number one, they can spend less money. Does anybody think we're going to spend less money in DC? We do not. Number two, they can make more money. There's 2 ways to make more money. They can either grow the economy. That's what Trump's been trying. Or they can try to tax their way out of the situation. We believe you're going to see both at some point. Right? It is hard for us to fathom that you will not see taxes go up from their current level, regardless of what happens in 3 weeks. Right? Because history says we tend to, again, go back and forth between trying to grow our way and tax our way out of these situations. So be very careful with the way you invest your non-qualified dollars, because it is entirely likely we will all pay more taxes in the not too distant future if we had to guess. But none of that will fix the problem. And so what the Fed is doing, in our opinion, is they're going to try to inflate their way out of the problem, right? So if you have debt and you only have to pay 1% interest on debt, and yet inflation goes up 3% every year, you are technically eating into the value of that debt by 2% every single year. And that's what the Fed is going to try to do. They're going to keep their borrowing costs so low, and they do that through bond yields and cash yields. They're going to keep their interest rates so low, and they're going to try to have inflation be 2, 3, 4%. That means that the size and the value of that debt will look smaller and smaller and smaller over time as the price of your house and your medicine and your investments go up. That multi-trillion-dollar debt will look less overwhelming, slowly but surely over time. So that's the plan. It seems to us that's the plan. Who loses in that plan are people who are overly conservative with their investments, right? Because again, if you are sitting in cash paying nothing and inflation is 3%, you are technically losing 3% every single year, right? If you are sitting in bonds yielding 1% and inflation is 3 or 4%, you are technically losing money and buying power every single year, right? So Jeff, the answer is probably all of that, right? Because if they don't do something, right, the market will call us on this at some point. We believe that's not going to be anytime soon. America will be the reserve currency and the bond market of choice for most of our lifetimes, if we had to guess. But at some point, if we don't get our act together, we will get penalized through higher interest rates if BlackRock had to guess. So hopefully that addresses some of that concern.
It does. And I think that's probably a common consensus with it's something people are worried about, but it's not right here in front of us. And so I guess that's good. But it's also the reason why we keep kicking the can down the road. We do have two good questions. One, the possibility, this question specifically says, the possibility of Joe Biden become president scares the dickens out of me. Please calm me down. I suspect we'd have other folks saying the possibility of Trump being reelected scares the dickens out of me. Please calm me down. You already hit on that, but would you just hit another one that it almost doesn't really matter to the financial sector of who the president is?
History says it doesn't matter. I know you don't believe that. I know there are lots of people on this call that do not believe me saying that to you, but lots of data and lots of history says it will matter in the short run. It will not matter in the long run. And the reason is Southwestern will adapt. BlackRock will adapt. Coca-Cola will adapt, right? Companies will take the rules as they're laid out, whether it's corporate taxes going up or down. Companies will take those rules. They will find loopholes. They will adapt, and they will grow their businesses again, right? The American machine takes the rules and rolls on, and it has for a very long time, and there is nothing telling us this time is different from that. The Biden policies, if that's your concern, sounds like they could potentially put corporate taxes back to where they were before Trump. That would still be historically low, not as low as they are now, right? And the other thing that we remind people, especially because we're in Middle Tennessee and there's so many conservatives in Middle Tennessee, is that there are still Republicans in Congress, right? There are still moderate Democrats in the world, even if it doesn't feel like that when you're watching the television sometimes. And the other thing to keep in mind is rich Democrats don't like paying taxes either, right? Just think about the fury that happened when the state and local tax deductions went away from northern states, right? And so the idea that all of a sudden we're all just going to start paying 60, 70% income taxes is just not realistic in our opinion. So look, are there things that you wouldn't like? Probably, right? But there are things the market would like very much, like the trade war with China would probably settle down some in the near term, and the stimulus party would absolutely go on, right? That's not a 50-year solution, but it does mean your investments would probably continue to do okay, regardless of what happens. And that goes back to my point, Jeff, which is there's just too many inputs. Like buying or not buying stocks because of who's in Congress or who's in the White House is missing the forest from the trees. That's one tree in a much bigger forest, history tells you. So hopefully that addresses some of that.
That does. That's brilliant. Wow. One last question that's slightly different than the current market, but a little bit broader education. And the question is, to achieve good diversification, what non-stock, non-mutual fund investments do you suggest? Is real estate a good source of diversification? Would you talk just briefly on BlackRock's perspective on diversification?
Yeah, I think the way I would answer that is to say your portfolio is likely to be more colorful in the future than it was in the past. And what I mean by that is, regardless of your age, since the Carter administration in the 70s, you could have gotten away with a classic all stock, all bond portfolio, and you would have been just fine, right? Bonds have been spectacular for 50 years. Stocks do what they do, right? Long-term averages around 10%. So that classic portfolio, very simple, vanilla has worked. The problem now in the recipe is not the stocks, because stocks will do what they do. The problem in the recipe is your cash and your bonds. And so the question really becomes, where are we going to get some return from? And the answer is, frankly, other places. right? So I would just kind of open your ears to the idea that your advisor at some point in the not too distant future is likely to talk to you about non-stock, non-bond investments, mostly because we kind of have to at this point, because the Fed has bought all of the bonds and they've driven the yield so low that the bonds in your portfolio are not going to do 6, 7, 8% again the way they have historically speaking. It's just not mathematically possible. You're not a nerd like I am, but bonds are just math. And when yields are this low, it's just really hard to find 6 or 7 or 8% returns from bonds in that world. So real estate, things like commodities over time, there are other alternatives that places like BlackRock manage that you are probably going to see in your portfolio at some point. We would just be very careful though, because things like real estate and commodities feel like stocks, frankly. They have volatility that kind of feels like stocks to us. And you lived that this year, right? The first quarter of this year, right? Real estate in some cases down 30, 35, 40%. Same thing with commodities. That's not bonds. Like when you think about the bonds in your old sleepy fixed income, old sleepy bonds in your portfolio, that's not down 30 or 40%. And so we would say yes, but I guess is the answer to that question. We all need to look further to find yield and return than we have historically speaking, but just be very careful with replacing something conservative like bonds with something super aggressive like commodities or real estate. Does that answer the question, Jeff?
That does. On that topic, with the market being high, so the question is, a client has a college account that's set up, and their daughter's going to school next year. Should they start to move out of the market and put it in cash now? I'd love to hear your answer, Cullen. I'll give you.
I'd love to hear the financial planner's answer on that, Jeff. I mean, because honestly, it's more of a planning question than it is a market. No one can predict the market, not BlackRock, not anybody, right? But I'd love to hear how you would respond to that question.
I'll never resist trying to get you to predict the future. That's always it's always worth a crack. But I think from a planning perspective, our answer would be that the market is it is where we know it is today. It could change either up or down in the next year. But if we have a need in 12 months for school, you sure would hate to leave the money invested in the market drop and not have those funds available. So from a planning perspective, it's always prudent to take money off the table when your investment horizon is only 12 months. And it just so happens that we're really fortunate to have the market up. So it would be a great time, in our opinion, to take the money off the table, park it in cash. Obviously, we're not going to earn any money, but at least it's safe and stable, and you can write those checks to college when your daughter goes next August. So from a planning perspective, you never will go broke with having that money that you're going to need in cash. So that would be our suggestion. Okay, good. I've got one last question here, and Cullen, appreciate you. I think this gets back to this concept of we had the opportunity to go years ago to Warren Buffett's Berkshire Hathaway meeting in Omaha. 40,000 people flood the Coliseum there to listen to him speak. It was unbelievable. They had Bill Gates and the whole board of Berkshire Hathaway there. And everybody thought that, I think they were going to hear from Buffett that you need to invest in this company, you need to invest in this. And after about the 10th time of repeating this concept, I think everybody said, we get it. He said, listen, in order to be successful, you need to do 3 things. You need to have a lot of cash so you can weather the storm. You need to have great investments, and you need to be really well diversified through stocks and bonds. And that's what he's encouraging his trustees to do with his money when he passes away, is to have good diversified investments, lots of cash, and then to your point of rebalancing when things are up or down are really wise. So so this question is along those lines of international markets, and those have been volatile. What's the future potentially look like, both in the short term and long term, for international and global investments?
Yeah, look, to be clear, America has been better as an investment for a long time now. 10, 12 years, America has been a better investment. History also says that kind of drifts back and forth. We go on basically 10 to 12 year stretches where international is better than America, and vice versa. What we would say about that is Americans tend to own too much America, and everybody does that. Italians tend to own too much Italian stock. French own too much French stock. Americans own too much American stock. And it's because it's what we know, right? It's what we're comfortable with. We would say, don't let America having been better be the reason you expect that to continue in the future, right? The old past performance is not indicative of future results probably couldn't be more true than it is in both bonds and international investing right now from our seat, right? And so the way that we think about it is, first and foremost, Europe, especially right now, and we don't love it. By the way, we're still overweight the United States, so let me just be clear. But the reason you still own it is that Europe is ahead of us from a reopening standpoint, and they are now stimulating the bazooka out of Western Europe, just like the United States is. That means their companies are probably going to do okay in the near term. The other one we hear a lot about is China, and we hear a lot of what I would call social objections to owning anything from China, and we get that, right? That makes sense. The challenge is if you remove China from your portfolio, you are removing the largest, fastest growing investment market on the planet. And you got to be careful how you do it. But we would just say, what if I told you that soda was the fastest growing market in the United States and you stripped all the soda out of your portfolio? You can do that, but there's a cost to doing that. And it's not unlike some international markets as well. So we would say, yes, America's been better in the past, but you're starting to see signs of life overseas. And so we would just be very careful going to zero because, again, history says that would be a mistake.
So this is a bonus question, and BlackRock has really been on the forefront of utilizing your influence to make an impact, but also recognizing that making money is BlackRock's ultimate objective for shareholders. But the question is, for layman's terms, speak to the imperative to address climate goals by the global community and its effect on the markets. Would you give us kind of the BlackRock's insight on how you guys have been able to do both of those?
Yeah, so we would say there's the social aspect of it, right? That some people invest that way, socially responsible investing. Some people call it ESG investing, environmental, social, and governance investing. That those things you can invest with your heart, right? And if you believe that's the way you want to invest, there are now many more ways to do that. You can also invest with your head. And that to us is actually the more interesting way to think about it, because there are so many people around the world now investing with their heart, right? Your kids are significantly more likely to care about climate change than your parents were, right? As the money rolls downhill, people care more. Europe cares a lot about climate change, right? Many parts of the world, it's a big part of the discussion. And everywhere we go all around the world, our CEO, Larry Fink, would tell you that is the one question he gets asked more often than not is, how are we going to invest more responsibly? So whether it's pensions, whether it's sovereign wealth funds, whether it's endowments, all these huge investors now care a lot more about climate change and all these things that they frankly didn't care about. People only cared about making money 20 years ago. Now they want to make money and do good. They want to do well and do good. And we hear it everywhere we go. And so what I say to people is, regardless of your politics and regardless of your view on climate change, real or hoax, doesn't matter. If I told you everybody in the world was starting to care about companies that grow dividends, right? Everybody in the world was starting to look for companies that grow their dividends every year. Would you believe that companies that grow their dividends were going to do pretty well, right? If I told you the world really likes red cars, do you think red cars would go up in value or down in value? They'd go up in value. So if millions and billions of people around the world are now investing with their heart, that tells us that companies that meet that criteria should outperform over the next 10, 20, 30 years because there's more money chasing the same kind of concept. So regardless of why you get there, we do believe there's a case to be made for investing that way, right, with some environmental, social, or sort of governance lens, because everybody else is. And if everybody else is chasing those kinds of stocks and bonds, those stocks and bonds are probably going to do pretty well, in our opinion. So hopefully that's an interesting answer to your question.
Yes, it was. And I just, the last comment here was awesome presentation, very informative. So Cullen, well done. And thanks for all of our clients joining and for your feedback and questions and the compliments to Cullen for he really is one of the most insightful and also kind and thoughtful guys, and just happens to be here in Middle Tennessee and run BlackRock, which has just been an enormous winner in this business and a good partner for all of us. So thank you. And I would ask all of our clients, please reach out to your advisors if you have any questions, and buckle your seatbelt because it's going to be volatile for the next month or so with the election. But this too shall pass, and it's already happened over the last 8 or 9 months with COVID. So we're grateful for everybody. Mr. Roberts, thanks for joining us, my friend. Have a good day.
Thanks, Jeff. See y'all.